Hello. Welcome back to Slam Capitals. And in today's video we're going to be talking about liquidity. And in this video today, we're going to be talking about how to spot liquidity. We're also going to be talking about how to identify liquidity, how to use liquidity, and what is liquidity. And if you're interested for videos like this, you can actually subscribe to this channel. Also follow me on Instagram, where I drop a lot of daily content and anything related to Forex and supply and demand. And if you're also interested in joining my team, you can actually find my course in the description below this video. So let's get into this video, and hopefully you guys enjoy and get a lot of information within this video. And let's get into it. So liquidity. What is liquidity? How to spot liquidity, types of liquidity into the market, and how to actually use liquidity. For example, if you actually ever enter the market and then you place a trade and then price ends up taking you out of the market, and then once price takes out your stop loss, and then price ends up going into the direction of which you actually intended for it to go, and if that ever happened to you, that's a form of actually being liquidated in the market. And in this video, we're actually going to be breaking down all those things, and that's to actually avoid being swept out of the market or being liquidated in the market. And in this video, we're going to be talking about all those topics and how to actually avoid that, and how to actually use that into our advantage, so we can actually have a lot of high probability trade setups. So what is liquidity? Liquidity is the footprint left behind by huge financial institutions and big hedge funds. Liquidity gives retail traders a clue of where all the buyers and sellers are resting on the chart. Huge institutions use liquidity as a way to keep the financial market balanced and afloat. Institutions and huge hedge funds use the use of liquidity to move price from one level to another in a high frequency level. So what I'm actually meaning right here is that liquidity can actually be seen in the chart. You just have to actually know how to see where it is. And most of these huge financial institutions and hedge funds, they target those areas of liquidity to actually take traders out, liquidate traders, so they can actually push the price to where they actually want it to go to. And for us retail traders, we have to be able to identify levels of where liquidity is, so we can actually avoid those areas, so that when huge institutions pushes price in those areas of where there's liquidity, to actually liquidate those areas, so that we should not be part of those traders who are being liquidated. So that's pretty much what I'm meaning on this slide right here. And how to spot liquidity in the market, how to identify liquidity. And the best way that I can actually put it into is examples of liquidity in the market. And liquidity can also be identified as a form of imbalance or fair value gaps in the market. That's a form of liquidity. Fair value gaps or imbalances are forms of liquidity into the market, because once the institutions push price, they have to actually bring back price back to actually fill those imbalances or fair value gaps, and then tapping into a demand zone to actually push price back to where they wanted to go. Liquidity is also found on levels of inducements in the market, and inducement is also going to be one of the things that I'm going to actually be breaking down into the market today, because most of the time price will leave an inducement, which is just a level which didn't actually feel or didn't mitigate a demand or supply zone. So price usually leave those type of areas, and then price ends up coming back and liquidating those areas, and then tapping into the area which they wanted to tap, which is the demand and supply zone, and then that pushing price back to where they wanted to go. And liquidity is mostly found on areas of support and resistance levels and range gaps, all equal highs and equal lows. This is an example of equal highs and equal lows. So there's a bunch of traders actually placing their trades right here, and also a bunch of traders which are actually buying their trades right here, their setups. And then what ends up happening is that all the traders which place their orders right here, they're expecting price to actually hold at this area in the near future. And all the traders that entered right here too, they in the same belief that once price comes back to this area, the one price will actually hold. But what ends up happening in most cases, price don't hold. Price might hold for the first, second, or third, or fourth, but it's not gonna hold forever. Price gonna end up breaking. And I'll also be giving an example of support and resistance in the further slides. Equal highs and equal lows illustrate the areas in the market where a lot of retail traders execute their positions or sitting buyers and orders. That's pretty much what I was explaining earlier on. Institutions usually target these areas to grab out all the sitting orders before going to its intentional direction, leaving retail traders out of the race. I kind of had a mistype right here, but hopefully you guys actually understand this statement that I was making right here. But pretty much what I'm saying is that once institutions or use huge hedge funds that usually push the market or actually make the market, once they see liquidity, they targeting it in a way that they end up liquidating those areas, taking out all those traders out, and then pushing the market to where they actually want it to go. Pretty much what liquidity is just money. It's us traders. Once you put your money in the market, you place a trade, either a sell or buy, you become liquidity. And what happens is that these institutionals or hedge funds, they come in to take your money by liquidating you, and then once they grab the money from you, they use that money to push the market to where they want it to go. So pretty much that's what I'm referencing to right here. So this is different types of liquidity. So right here we have the equal highs and equal lows, and then a bunch of traders placing their trades right here, a bunch of buyers that are buying their setup right here, but the sellers which won't place their trades right here, they end up getting what, taken out, swept out by liquidity. And then once they got swept out, price came back, mitigated this demand zone, and price got pushed back to where they wanted it to go to. And this is the same thing, this is the same concept right here. A bunch of buyers, a bunch of sellers, place their trades right here, and there's a bunch of buyers right here. But all the buyers right here were expecting price to actually come back, hold this area so they can actually push price backwards. But what ended up happening is that they ended up getting liquidated. So every single person who had entered right here or placed a stop loss below this area got taken out, got took out. And then once they got took out, price ended up going back, mitigated that area, and price ended up pushing to where they wanted it to go. And this is a trend line. Liquidity example. So you see below this line right here, every single person who placed their trades below this area, they're expecting price to what, bounce off this area, bounce off this area, bounce off this area, and pretty much it might hold for now, but in the future this area might not end up holding, and price might end up breaking that area. And right here we have a good example of an inducement. So this is just a failed mitigation. This is what I call it. I call inducement failed mitigation, and it's pretty much more of a trap. So a bunch of traders, because price broke structure after it came here, there might be some type of like demand zone right here. But the main thing is that we have this demand zone right here, which was not actually mitigated, but they set up. So price came back, liquidated this area right here, taking out every single person who actually placed their trade right here. Once price took these traders out, what did price do? Price mitigated this demand zone right here, and then price got pushed to where they actually wanted price to go to. So this is a perfect example of an inducement. And yeah, this is a good example of how liquidity is used. So right here, you guys can actually read all this at your own time, but I'm gonna try and break this chart right here. So we have a break of structure, and then we also have an imbalance. So pretty much what imbalance is that there's just a huge order was actually placed right here, and a lot of people, a lot of traders and retail traders didn't actually get an opportunity to actually enter within this move. So what ended up happening is that price actually has to come back to fill this order. You remember in my previous slide, I said that price institutions, they use liquidity as a way to actually keep the market in a balanced state, or in a balanced state. So what I was pretty much meaning was this right here. So because a bunch of traders didn't enter on this move, because a bunch of traders, retail traders, didn't enter on this move, what ends up happening is that price is sent back to fill these orders and giving all the other traders an opportunity to actually enter at this area. And the people that actually entered right here, ended up getting liquidated, ended up getting taken out. So if you place your order right here and you had your your stop loss below here, you got taken out because price had to fill all the orders that were right here to give all these other people a chance to actually enter this trade. So yeah, and it's another good example of liquidity. So right here, when a bear trend, price is going down, and what happens right here is that we have a high, and then we have so we have a high, equal high, equal low. There's an equal high, equal low. So all the traders which we actually entered right here, they're pretty much expecting for price to do it, price to still hold right here, so price can do it, can go down. But what did price do? Price took out all the liquidity, so every single person who placed their trades right here and their stop loss right here got taken out, and price got what? Price got pushed below. So this is a perfect example of equal highs and equal lows. So yeah, and notice one thing: every single time that price mitigates a supply or demand zone after taking out liquidity, that price pretty much tanks. So this is another example. This is a perfect example of our liquidity. So we can see that price is in an uptrend, and we have this low right here, and we have this low. This is pretty much a perfect form of liquidity. Price held right here. Retail traders might actually expect price to actually hold right here, which actually did, and expecting price to actually hold right here, which it did. And in their mind is that when price comes back around this level, price is gonna what? Price is gonna hold. But what price ended up doing? Price ended up liquidating all these areas, taking out all the stop losses and all the money that was right here, and price ended up doing what? Mitigating this demand zone, and price did what? Pushed. Price got pushed back up, and all the traders which were right here were taken out, and all their money were taken out, and then yep, the rest was history. So these are all the examples that I have for you guys, and I'll actually be going in the live chart and breaking down more examples of how liquidity is actually used. I'll be giving you guys more examples so you guys can actually see. I hope this was helpful, but let's get into the chart and let's see. Hello, welcome back to Slang Capitals. And right now we're in the live market, and I'll be breaking down more examples of how liquidity is actually used. So when we see right here, price broke structure, and right here, price broke structure, but price ended up leaving this form of inducement right here, with an inducement right here, and we also have this inducement right here. But price didn't only create areas of inducement. Since price left this inducement right here, price ended up creating another form of inducement. But once you end up connecting it together, it's a form of liquidity. So there's a bunch of buyers. There's a bunch of buyers right here, and there's a bunch of buyers right here. So for me saying this and us saying this, we already know that since there's a lot of buyers right here, and there's also a level of a demand zone right here. Let me go to the lower time frame so you guys can see. Let me go to the 30 minutes. Yep. Oh, you guys might not be able to see that on the high time frame. Yep. So it's always good to actually, when you look in your market, when you mark in your chart, always make sure you find the perfect area of demand or supply area, because if you didn't really know, most people might actually end up placing their demand or supply zone, their demand zone right here. That's going to be for a different video. We're going to be breaking down demand zones and how to actually find those. So you see right here, this my demand zone right here. This is my demand zone right here. So price ended up creating this liquidity level of liquidity right here. Me knowing that, I'm expecting price to do it, liquidate this area, tap into this demand zone, and then I'll be expecting to do it to place a trade. So let me zoom into this so you guys can see it perfectly. Okay, good. Now let me replay price. Replay price. You see what price did? Price liquidated this area. It took out all the sellers, all the buyers. Took out all the buyers which were sitting right below this area right here, and then price ended up doing what? Mitigating our demand zone. And what are we expecting? For me, I'll be expecting price to do what? Go back up, and it's pretty much what price did. And notice one thing: once price takes out liquidity, take all the money that's right here, and then mitigates our demand zone, price goes up fast. Price goes back up fast without even giving a chance to other people to actually enter the market. So that's one of my first examples that I have for you guys regarding liquidity. I'll take that out. So I'll be just looking for more examples. Yeah, this is another example that I have. I actually took this trade. I don't know when I did. I actually took this trade. I believe I got it on my Instagram, if I'm not mistaken. So let me break this down for you guys. So we see that price is dropping. Is in a downtrend, and then we have this equal high and equal low. And what do we know about equal highs and equal lows? It's just a form of liquidity. So there's a bunch of traders which are placing their sells right here and their stop loss above here, and there's just a bunch of buyers who are buying right here, keeping their stop loss right here. And what are we intending? What are we, when we see this, what are we thinking of? We expecting price to do it, liquidate this area, take out all the buyers, and take out all the sellers right here, so price can do what? Mitigate our supply area. And once price mitigate our supply area, we're gonna be waiting and expecting for price to do it, to go in our intended direction. And this is a really huge tool to use when you're trading. Like for me, for example, when I trade, liquidity is part of my trading plan. I wait for the market to generate some type of liquidity, and then price to take that liquidity out and then mitigate my area, and here we go. So let me see what happened. Price mitigated the demand zone, the supply zone. I don't know why I keep on saying demand, but price mitigated the supply area, liquidated this area right here, and then price did what? Price tanked. Price ended up tanking. So that's one of the examples that I have for you guys. Let me look at my other example. Let me see, is this one? Nah. Okay, I'll be looking at this one. Good. This will be my last example that I'll be giving you guys. This is my last example. So this is a perfect example of let me see, the 2 hours. This has to be in the 2 hours. Yep, it's on the 2 hours. This one I seen it. So I actually didn't take this trade. I actually seen it. I had my eye on it, but I didn't take it. But I just wanted to give you guys an example of this setup because it was a really good setup. So this is an inducement. This is an inducement example of liquidity. So we have price came in this area right here. Price failed to mitigate this demand zone. This is a failed mitigation. So there's a bunch of traders who actually place their trades right here, and then believe that price is actually gonna hold in this area and price is gonna push. But what price ended up doing, price came back down, swept this area right here, swept all the stop loss which was sitting right here, and then price ended up mitigating our demand zone, and price did what? Price pushed back up. Let me push that so you guys can see. Price mitigate that demand zone, and then price do what? Price went back up. So that's pretty much how I use liquidity in my trades to actually get good setups, higher probability setups. So if you're actually interested in learning more about concepts like this, you can actually subscribe to this channel and also follow me on Instagram at Slaying Capitals. And if you are actually interested in my course or joining my team, you can actually find all the information down below in the description. And that's all I have for you guys, and peace out.